Russia shocked the world last week by pulling out of its alliance with OPEC. Putin's refusal to join the cartel looks partly aimed at bringing down US shale oil companies that rely on higher prices to meet their extraction costs. Russian oil companies had been supposed to meet with the Russian energy minister to discuss the possibility of resuming cooperation with OPEC. Instead, discussions sidelined OPEC, with giant Gazprom Neft stating that they are getting ready to increase production in April. A return to OPEC does not appear to be on the cards. Russian oil companies have been against the deal for years and do not support further production cuts, which in their view simply take cheaper Saudi and Russian barrels off the market, replacing them with more expensive US shale. The move appears to have angered the Saudis, who are now flooding Russia's European customers with their lower-cost products. The kingdom have intensified the oil price war by ordering its state-owned producer, Saudi Aramco, to raise the maximum production rate to record highs of 13 million barrels a day, up sharply from less than 10 million barrels in recent months, in what looks like an attempt to corner the global market. Recent events appear to indicate that both Russia and Saudi Arabia have the economic capacity to keep a price level of $35 per barrel for 4 to 5 years. The question then is how much damage this would do to the US shale industry. It is estimated that $40 per barrel will only slow its production growth, with a price of $30 per barrel keeping it at levels seen in December 2019. In order for US shale production to drop, prices would either have to fall below $20 per barrel or stay in the margin of $30 to $40 beyond 2020. This is also without taking into account Washington's announcement that they would be helping the industry by buying up supplies, a tactic that will protect it from the worst effects of a reduction in prices. Should oil prices fall into the $30 territory, it could also hurt oilfield service companies as big producers cut their spending on new projects. According to analysts at Rystad Energy, this spending could fall by $100 billion in 2020 and a further $150 billion in 2021. Bankruptcy fears are indeed starting to ripple through the oil patch, sending the SPDR S&P Oil and Gas ETF to its lowest price on record. Shares in major oil companies all fell on the news, with debt-laden Occidental Petroleum falling 52%. There are fears that recent events could trigger a repeat of the 2014 to 2016 oil crash that bankrupted dozens of American oil and gas companies and caused hundreds of thousands of layoffs. According to Ryan Fitzmaurice, an energy strategist at Rabobank, Russia sees US shale as particularly vulnerable at the moment. It is our view that Russia was targeting debt-laden US shale producers. Many suspect the moves were in retaliation against sanctions imposed by the US that were only possible because of the shale abundance, including those announced in the last few weeks against a subsidiary of Russian oil giant Rosneft in response to its support of Venezuela's Maduro regime. COVID-19 fears have also been adding to the oil industry's woes, with flight cancellations, factory closures, and quarantining all reducing demand. The shale oil companies with the weakest balance sheets may not survive, with analysts predicting consolidation as well as bankruptcies across the sector.